What do I got here today? The FTSE, the FTSE UK 100 index, UKX. Do I got any more info on that? No, that's pretty much it. I got the monthly candle chart, and look at this thing. It's the first time I'm starting to know these monthly candle charts since they condense a lot of information. I've been deep diving a lot of these gold index charts over and over, and it's like I know the shapes of them by heart, especially the closer, the post 1995 ones. After that, it's hard to see because if you see this looks like super small movement, but actually it was a lot of movement, but it's just getting in relationship to the other moves is just so smaller. And look at that, man. Look at those tops. Oh, 1999. So I don't know much about the FTSE. I don't know much about its relationship to U.S. sectors. Kind of cool. I have a lot to learn about European markets, Asian markets, any other market other than the North American markets, which we're very familiar here. But some people in the UK probably look at the FTSE a lot, just like maybe we look at the SPX, or maybe they don't. Maybe they look at the SPX and they don't care about the FTSE. So where were those highs? Those highs were in December 99. And is that a high? What's a high here? High 67.54. 67.51. So 67.54, 67.51. So the high was in July of 2007. Wow, okay. And then these had a synchronous breakdown. Like I said, this one broke down before. See, January of 08 had a nice breakdown. Just like we're seeing today, the European markets breaking down before the U.S. markets. Maybe the people see the U.S. markets as a flight to safety, the last stock market of all of them to fail. And when did this break? Wow, a lot of noise, man. Look at those wicks. There was a lot of noise here. Those wicks, remember, that's action from the daily, from the weekly. Oh, tested. Didn't go down, close above until you had to close here. Then you had to pull back up. You actually had right here. The closer the defined resistance or support to the breakdown line, the more it's valid. So right here, you had a nice top formation. Look at that. Look at all these tests. And then when you had to close, that was it. That's the breakdown here, declining 12-month moving average. Breakdown, pull back up below, never closed above the 12-month moving average. Had a little peak above, and then the next month down, sideways move, getting closer to 12-month average, down, sideways move, close to 12-month moving average. Look at that. No close above the 12-month moving average. Down, sideways move, down, sideways move until you got to close above, and then you are out. So using my just the monthly candle, the close above the 12-month moving average, below horizontal breakdown line, declining 12-month moving average, just those observations, like Stan did on the 30-week, on the weekly chart, signaling that you're in a downtrend, or it's just a few observations which really give a lot of weight to the weight of evidence. There's other elements you add in to avoid whipsaws, like economic data and stuff like that. But just this, it's enough to tell you can short here. You don't go short when you have a close above a declining and an inclining 12-month moving average. But this would have been your final exit. If you didn't listen to anything else, this would have been okay. I'm out, and I'll have to wait to reassess. Sometimes it goes back down. Sometimes it keeps going up, goes sideways move. You don't care. You want to ride the majority of the trend. So that's how you do it. That's what I'm looking for today. I think today in 2018-19, this is what's happening. And that's what I'm expecting. That's what I want to see. That's where I think this is a low risk environment to short. riding a declining 12-month moving average, was just starting. So it's the beginning of a cycle. It's very contrary than having a beginning a here like this. Right here, I would look to go long. I wouldn't look to go short right here. I have an inclining 12-month moving average, and I'm right at the beginning. So right now, you see, this is just beautiful. Horizontal breakout line, inclining 12-month moving average, and that's all you need to know right here. And the FTSE, you would have entered right here, this monthly candle close, sideways move, never closing below. Look at that. It's insane. Up, sideways move, never going too far away. Up, sideways move, up, sideways move. Noise could have whipsawed you out. Kept going up, up, up. And then you would have sold. Where's my first close? Right here. This would have been the final warning sign. A lot of warning signs here. A lot of these wigs below could have really got emotionally, might have triggered out. You might have said, would have went on the weekly and said, I'm going to cheat, I'm going to get out. But this would have been your final warning sign. So if you didn't even look at anything else, at trend lines, at other factors, this would have been your final exit strategy right there. So pretty sweet. One buy order here in 2003, October. One buy order 2003 in October, and 5 years later, 2003, or 4 years later, in a few months, then you exit, and you would have you would have rode all this up. So that's where I think we are today in this top pattern. I don't see the use of looking for a continuation pattern when we're here, when unemployment is at all-time lows or very close, very low, that it has more chance of going up than keep going down, that the interest rate, have the cycle of raising interest rates it's already stopped, or they're going to pause, and then when it starts going down, the interest rates, the cycle, that means it's over. It coincides with unemployment going back up. All these things, these formations, huge wicks down, close below important monthly defined support. See that? Look at the impressive pullback in 2007, 2008. Look at that wick above. If you looked on smaller time frames, everybody would have gave up here. Everybody that was short here thought this was going to crash. That pullback could have triggered a lot of people out. But that's just noise. Here's my monthly defined breakdown line right here. Big wick buyers coming back in, saying it's not quite time. Just like our December rally we had in the SPX, came back up. This one went even lower, came to test it, but then strong, vicious rally up, just like we're doing now. Now we're a little bit higher today in the U.S. markets. But after that, no, that's the exhaustion candle. Icarus flying close to the sun, last gasp of air above the clouds, and down. The reality sets back in. There was a reason that you had this red candle. There was a reason that the price action was below the 12-month moving average. There was a reason. And if you can't get back above, and especially after a long run like that, and if I would overlay with the economic data again, you would see that the unemployment rate would have been super low. That means that's the end of the cycle that you see it super low. Would have seen that the rate cycle would have been started being paused. Rates could have started being cut. But that happens always here, not before. The cuts, they happen here. So you're already in a downtrend, because the damage of the interest rate hikes, when you're hiking here, it's projected in the future, and the damage, you feel it a little later on, guys. So that's pretty much it. Look, pretty cool. Drop. Another good entry right here below this bigger pattern. Again, that's all stuff I'm looking for right in today's markets, in the U.S. markets. And if they could just stop printing money and buybacks and let some natural stuff, a little more natural movement happen. But whatever it is, I'll wait for the price action to really tell me. And then I have measured move, down, swing rule. Here you could have thought of exiting, or you could have continued to ride it until, same situation here. Here you see V-shapes at bottoms, not at tops, not in rallies, V-shapes. You always retest breakdown at the top of a cycle, at the top of a monthly candle chart, breaking down, turning over. There's a retest. Down, up, down. V-shape recoveries, you see them at bottoms when you've been going down a downtrend for a while. That's when you see bottoms. V-shape. You don't necessarily retest. Maybe they retest here on the daily, but on the monthly, this is very possible. You don't see this here and then you skyrocket to the moon. You just don't see it. It just does not happen at the top of cycles, especially when the economic data matches the price action, when it matches monthly defined breakdowns. So top pattern, broke down, pull back, create a bigger pattern. This is all stuff that repeats patterns on top formations of markets. They resemble each other. There's a lot of similitudes. And right here, this would have been the bottom. You don't necessarily go back in here because the 12-month average is going down, but you don't want to short. So here is your exit. Here you could have entered. Here you could have entered on the close back down here. This would have been a very nice, protected by support, turn, resistance. Entry here, and exit here. Worst case here, you exit wherever you got in here. So here you could have added your position. Somebody could have actually entered here on the embryonic breakdown, half position, another half position here, or a full position, close here, half position, pull back 12-month average, another position. So here, that's where you load up. All this zone here, just like we are today, that's where you load up. And after that, you write down and you exit right here, all those positions. And that's what happened I love these. That was very nice. But this stage 2 was rocky. Not very clean, very hard to play. So that's not what I'm looking for. You want a strong ride all the way down here. This is messy. Wow, look at that. So very, very messy for the FTSE. Where are we today? Are we in a situation where is my horizontal breakdown line? There was one here, broke down. December, continued breaking down, pull back up, close to the declining 12-month moving average. And let's see if it could end the month below that breakdown line. That would be pretty sweet. And that would be a great risk to reward entry here. Below support and resistance, below a declining 12-month moving average. If that'd be a red candle, after that we'd get lower highs, eventually lower highs. And hopefully, especially since this is coinciding again with economic data that's signaling that we're close to these types of situations, that this could go back here and start doing a downtrend all the way down, bouncing off monthly defined support that we're going to find along the way, creating bigger patterns, giving more implied measured moves until one of those measured moves, we just don't hit it. Recovery happens, and after that, the price action closes above the 12-month moving average, just like we saw before here, and then you're out. Rinse and repeat. Risk and money management. Make sure in case there's these situations where you didn't look at the whole weight of evidence and you got whipsawed because you entered here, but finally there were other weight of evidence telling you that you shouldn't have been entering there that could have avoided that. Make sure you get your position size not to lose more than 1% per position, and have a nice ride and safe. Stage 4. Thanks, the FTSE. I think I'll come back and do some more European indexes and anything that's not North America. Cool stuff. All right, guys. Thanks for watching. Ciao, guys.